Very good afternoon to all our viewers. Today we have with us a very special guest. She's the CEO of Eccos Impact GmbH, which provides business intelligence to investors and corporates on sustainable finance. She is also the editor for Sustainable Finance and SDG Economic Series with Springer Nature. She's a lecturer for behavioral finance, impact investing, quality assurance, governance, change management, and international number one expert for responsible investment banking, sustainable finance, and positive impact investing. She has also held senior roles in banking and asset management over the last 20 years in the financial industry, and she has published several books in German and English and is now hosting her own sustainable finance series. Let us all welcome Karen Wendt.
Thank you very much.
It's an honor to have you with us, Karen. We would like to understand your journey.
Yes, thank you very much for having me. So I started as a very ordinary investment banker at Deutsche Bank, where I was working for the board, doing company valuations, going to general assemblies of investments that Deutsche Bank had. And then I was moving abroad. I had a small pause while living in Russia. And then when I came back, I started with another bank, UniCredit. And at the time, it was Bank Austria. And I did Eastern European strategy for them and was exactly doing the same thing, buying bank licenses, buying banks, evaluating them. And then I moved on to help to build up project finance. And we had a very clean portfolio at the time. So we did a lot of clean energy, we did a lot of wind farms, solar power, and so on. And this is why World Bank came to us in 2001 and said, hey, we're going to create an international standard and we're looking for some banks, commercial banks that would do that with us together and whether our bank would be on board. And so I moved into the sustainable finance world in 2002, thanks to World Bank.
Great. That's very inspirational. Now, you have been in this space since very early on. What did you want to change when you endeavored and studied environmental economics?
So what I would like to change, is that the question? Yeah.
Yes. What did you wanted to change back then, and what has happened now?
Okay. So what I wanted to change back then. So there were very dirty project finance deals worldwide, mountaintop removal mining, using child labor, and so on. And in 2002, there was the Cut Your Card campaign against Citibank, where celebrities were just cutting their card. It was an initiative by Rainforest Network, and they were showing pictures. This is Citibank financing. And you should not support that. Cut your credit card, I've cut mine, and you could do the same. And this really increased or created the first movement of sustainability in project finance at the time. And then, the idea really was to make bad deals better. So in two ways. First of all, to have a strategy and a policy to say, well, do we really want to finance mountaintop removal mining? Do we really want to finance shale gas? And if the answer is yes, because that's the decision of a bank and it depends on the risk appetite the bank has, then what are the conditions under, what are the things we want to implement in the credit agreement to really make sure that we can manage these risks. So we wanted to make bad deals better at the time. We didn't say, oh, we don't finance oil and gas, we don't finance mining, but we wanted to get the dirt out of it. And that was, well, let's say the first generation of sustainability. So there was no decision to abandon certain industries, well, except for very controversial issues like cluster bombs and stuff like that. So military finance, for instance, we excluded directly. We also had a policy to exclude nuclear at the time. So this had strategic reasons and had to do with the history of the bank. Not all banks do that. Yeah, and then we had created policies to make the business more sustainable when we finance. And so it was not on the asset management side, it was there where banks have leverage, where they really can influence a deal. It was on the financing side there where we started with amending credit agreements and making sure that this risks were taken, were accounted for. And we also made afterwards a small comparison. What is the risk profile? What has been the risk profile of our project finance activities before we introduced this extra financial risk management, and how did the risk profile change and get better through our activities in extra financial risk management? So that was the first thing.
Thank you for taking that initiative. Now we have so many other regulations in place.
Yeah, at the time we didn't have regulations in place, and I must say, so there was also a divide between banks. There were the banks who said, well, we are not going ahead of a regulator. Yeah, and my opinion to this is when you have a regulator, when you have it regulated, yeah, then it's not a market advantage anymore. Then it becomes a commodity. Everyone has to do it. Then it becomes just a cost. Yeah, and when you want to have it as an investment, when you want to have it as something creating alpha, then you have to be ahead of the regulator. Then you have to have better ideas than the regulator, and then you can also take the freedom on how you want to implement it. Because when there's regulation, the regulator will tell you what exactly to do and how to do it. And normally regulators kill innovation. So you have to find a balance. So how can you keep up the innovation? And that means being ahead of the regulator. And how much regulation do you really need in order to make sure that black sheeps as well to do the right thing? Yeah.
Sure, sure. Now, Karen, sustainable finance is such a wide topic and it is new in many of the emerging markets. How would you define and how do you envision its growth?
Yeah, so I would say in an emerging market, so we have, of course, how here in Europe, we have now the EU with its EU Taxonomy and its own sustainability definition. I'll come to that in a moment. But I think what is really important, sustainability is not just a marketing tool. If you use it as a marketing tool, then you will achieve nothing on the ground. Then you will just be in greenwashing. What is really important, you have to make it a business case. So you have to understand, how can I change my risk management to have to de-risk my portfolio of assets with sustainable finance, so with the concepts of sustainable finance. And you have to understand then, how is that an indicator even for innovation? So how can you move into markets which are innovative, and how, because it's a good tool for discovering that. So it can do two things. It can help you with risk management, and it can help you increase innovation. And I think that's the real impact it should have on the ground. Because when I started in our bank, so nobody took that topic serious. So everyone said, well, this is just marketing, and yes, and we're saying we're doing this and that. But no, you have to be able afterwards to show that you have been de-risking assets, that you have a portfolio with lower risk, that you have a better risk-adjusted return. And then there is the juice, because otherwise it will be very much a topic that cannot gain strength, that cannot gain support if it's just marketing, if it's just value signaling, then it will not get strong. And then we can see all the pushbacks which we see now, for instance, in the US, because it has been used very much as a marketing tool, and it has not really created the alpha for many American investors it should have. Because if you use it as a marketing tool, it is a marketing tool, and then you don't get better results.
Yes, indeed. Now, that's a great insight. Now, when we talk about sustainable finance, there are several tools to it.
Yes.
And there is a way that you can implement it in a business. So, what are the kind of tools and case studies if you would like to share of implementation of the same?
Mm-hmm. Yeah. So first of all, I think what is important that you have. So let's talk. We have two sides in investment banking, right? We have the asset management side or wealth management side, where you apply concepts like environmental and social governance, impact investing, and then you have the finance side. And the finance side, you want to make deals better, and you are very much with the World Bank standards. So yeah, they have performance standards which they discussed and agreed with 194 nations, which are all sitting in the World Bank board. So we can really say that is a societal contract and a global societal contract. And on the finance side, you can go with these ones because all nations have agreed on them. So on the asset management side, things get a little bit more scattered, because ESG is a concept which normally is based on sustainability reports. And so there is this global reporting initiative, and they have guidance now, notes how to establish a sustainability report, but it's all self-reporting. So any firm is doing a sustainability report. They more or less follow these global reporting initiatives guidance notes, and it's all ex post information, and it's all self-disclosure. So there's no audit from anyone. So you have to know that you are basing on a very, let's say, fragile databases, because as always, in any word, so the quality of the data is finally the thing that decides how good your asset allocation is. And so you have to really look into the ESG data with a grain of salt, and you can apply various strategies. You first can say, I will exclude certain markets. So I will not invest in military. I will not invest in cluster bombs. I will exclude controversial products and controversial business practices. For instance, you can say, I will continue to invest in mining companies, but I will not invest into mining companies that use certain technologies which are very controversial. Or I will not use mountaintop removal mining because you're cutting off the mountain, and you can say this is a controversial practice. So that's the first thing. You can have exclusion lists where you say, so maybe some people don't like tobacco, then you say, I will not invest into tobacco, or I will not invest into erotic producers, and stuff like that. So you can have an exclusion list based on controversial practices and controversial industries. And the second thing then in ESG, what you normally do is that you try to find the companies that are better than the market. So you want to find the ones which are best in class. And then, of course, you can also try to apply a risk strategy, like on the finance side, where you say, okay, in our risk evaluation, we will also take into account ESG. So this approach is called ESG integration. Um, I personally haven't seen any example that this is really working, because you have a very fragile databases, and if you try to do risk management based on that, yeah, that will be really difficult. And a newer approach is called theories of change and stakeholder engagement. So what you can try to do is to say, well, I'm BlackRock, I'm powerful. When I go to a general assembly, I have more than 50% of all votes, because yeah, all the pension money is with big guys like BlackRock, State Street, Vanguard. Then you can say, I can have a voting policy, and I can say I will not discharge the board. This happened, for instance, not through BlackRock, but through a company called Engine Number One in the US. It was a small NGO, and they collected, well, a small participation in ExxonMobil. I think it was just 1 million. And two guys, and then they went to the General Assembly and said, we will not discharge the board. We want to have a board member for ESG and sustainability. And they were then, well, really, yeah, motivating all the big guys like Vanguard and State Street and BlackRock, and saying, hey guys, you're sitting here, you have a policy, you have a voting policy, you're telling us that that you are applying ESG approaches, so you should really vote with us, and you should not charge the board. You should make sure that there is a board for sustainability. And this exactly happens, and that's a powerful example how you can, through stakeholder engagement, really as a shareholder or as a pension fund or a big fund, really tell the company, so you have to change something. So that is called theories of change. That's a quite new approach, and of course there are some some companies like Threadneedle. They are applying that approach, and they are also reporting on their successes, and they are divesting from companies which cannot, which are not changing according to their advice. So I think this is more or less what you can do with ESG. But be aware that ESG is always very past-oriented, because you're basing on sustainability reports that stem from the past. And if you want to be more forward-looking, then we move into the area of impact investing and sustainable development goals, the UN Sustainable Development Goals. There you can be more innovative. There you can be more forward-looking. But there you will need more and more complex tools to really filter out that companies that have a positive impact on the world. And here again, we have since 2019 an initiative between World Bank and 159 asset managers that apply the IFC performance standards and create impact assessments for companies that claim that they have a positive impact on them.
That's really nice to know, and it's very powerful case study. I must say that I'm sure it created a lot of impact. That one case study itself, that one NGO standing up for the cause.
Yes, that's a nice example, I think. Yeah.
Mm-hmm. Yes. Now, Karen, you are also in the forefront for encouraging women in fintech.
Yeah.
How is the response, and what more could be done in the emerging countries? We do have a women women finance minister, but I'm sure a lot of women are still lagging behind in the understanding of fintech. So, what more could countries like emerging countries could do?
So first of all, I think women have to expose themselves to the space, and then they will make the experience that it is not something very, very difficult. So Python is a very simple language, for instance. That's one language that is used in the blockchain. So you will see that fintech is not some hocus pocus or something very technical you as a woman are unable to understand. Um, I think when you begin to expose yourself to the space, then you will realize it's very often it's simpler than you think. Like with many things, we have fears, we have emotions, and normally a good way of dealing with bad emotions is really not avoiding them, but making some steps into the space. So maybe in the beginning some cautious steps, but make some steps and really take it more experimental and say, now I am the experimenter and I will find out whether that is really as difficult and as bad as I thought. So normally that's a great methodology always to deal with fears. And there are fears. The second thing, I think we have to start earlier. We have to deal at the scholarly level already with fintech issues. So we have to create the opportunities that females, that women can experiment in very simple, maybe creating a game in very simple languages to create something. Because women normally are good creators. They love to work with flowers. They love to work with, creating things. And this is also possible in the fintech area. So that's my second point. And the third point is that women, they are not so long in the business space. And that means they are happy to have a job. They are happy to have a work-life balance, get family, and work under one hat, but they are not investors. So women rarely invest. They are savers. They are good savers. They are normally taught by their mothers how to save money, how to work with the budget they have from their husbands, and so that's the kind of mindset that women are in, and there has to be a fundamental shift in this mindset. So women have to also experiment in investing with small amounts. They have to find out that they are able to do it, and that they can have much better returns than just by saving money. Yeah. So I think these are the most important things to be done.
Yes. Thank you for sharing that. I tried my hands in cryptocurrency though, but it didn't go very well. I hope it bounces back. The
Sorry?
cryptocurrency market. The cryptocurrency market. I hope it bounces back.
Yeah. And so are you happy with your investment in the crypto market?
I hope it bounces back.
Yeah. So yeah, that's true. So let's talk a little bit about what is risk. Yeah.
Yes.
Risk is normally a bell curve around a mean. So, and if you have huge chances, so cryptos go up a lot, then of course you have exactly the same risks. Yeah. So if the chance is big, the risk is big. If the chance is small, the risk is small. So this is something you have to be aware when you invest in crypto. It's a very, very volatile market. And in this, I would even say in this regard, market timing does matter. Yeah. So many people have invested when they thought that Bitcoin has now become mainstream. They invested at 60,000 and now it's 20,000. So yeah, that's a huge risk. You also have to understand that the crypto market is not really a liquid market. And that's a huge problem because you may know that Bitcoin started to tumble when Elon Musk, decided to exit Bitcoin. He said, well, after a long studying the phenomenon, he came to the conclusion that Bitcoin is using too much energy. So if you have investors that can drive the market, so if one person is divesting and the market tumbles, that's not the situation that you want to have. This is not the situation that you normally have when you invest in the stock exchange. Or in assets that are listed at the stock exchange. But that's a situation that you have in crypto. So there are some very powerful investors, and they have, through their investment strategy, the possibility really to drive the market in one or the other direction. So this is not a liquid market, and that's a risk that you are taking when you're investing in crypto. And I don't say don't do it. I just say be aware of that. It's not a liquid market. It's a market that can be steered by the investment of one or two persons, and that's a risk. But of course, you have
Thank
also
you.
high opportunities and high
Uh,
returns.
it- uh, yeah, it's such an education to know about this that the market shifters. So, yes, I'll be more cautious next time for sure.
Okay, yes. So if you invest small amounts, then I think it's not, yeah, it happened to me as well. I think if you invest small amounts, that's okay. You take a loss. You reflect of what you have done wrong. And I mean, like in entrepreneurship, in investing, you are just failing forward. And just make sure that you don't fail forward with very high amounts.
Sure, sure. Thank you for the great insight. Now, Karen, you have also mentioned about EU taxonomy compliant investing. Would you like to share a little bit more about that? And are there any regulations in EU on sustainable investment?
Yeah. So the EU really is of the opinion, well, of many, yeah, has created, well, made up its mind, and it came to the conclusion that sustainable investing is not a consistent concept, which is right. And so they came to the conclusion that they have to provide a new definition of sustainable investment. And so they are not starting with ESG. That's the biggest message, I think. Yeah, because in ESG, what you're doing, you're taking the investment universe. Let's say you take the MSCI or any index, and then you filter out certain assets. You filter out even more when you go for best in class. But it's a negative filtering approach. The EU has decided for a positive selection approach. So they have defined industries which they regard as green. And so they start with the positive selection of companies in these areas according to their green taxonomy. And they have defined, well, that should be abating climate change adaptation risks. So companies that address climate change adaptation risks, that abate climate change, that preserve biodiversity, that preserve clean water, oceans, and so on, that create a circular economy. And so these are the industries that are regarded as green. And so there is a positive selection of these industries according to the EU taxonomy. And in a second step, they have a do no significant harm provision. So you should not do any harm to any of the other goals. So when you invest in, let's say, solar energy, you should not put your plant into a biodiversity rich or even endangered space, because that would harm biodiversity. So do no significant harm provision means you are not you by doing the good, investing in solar, you do it in a way where it doesn't harm any of the other goods. And then there's in the third step, only in the third step, we're talking about ESG. So they apply the OECD norms-based screening. So there are a lot of ESG approaches. The OECD norms-based screening is one. And then you look that there is no child labor, no forced labor, and so on. So you look into the ESG issues in a step number 3. And of course, this is something that can boost these industries. So the green taxonomy can boost these industries. There's also a social taxonomy, which is under construction. And there is a brown taxonomy. So this is, the industries that the EU is not regarding as green, like mining, like oil and gas. So the usual suspects. And of course, it can boost the market, and it can also create concentration risks, as I discussed. Yeah, because you have only then 5 or 6 industries, that are regarded as green. So, yeah, pros and cons. So you should not only invest into that, into the green taxonomy industries, but maybe you can overweight it. So you give it a higher weight in your portfolio, being aware that you're taking a concentration risk.
That's very interesting. I don't know if we would be coming up, but yeah, India is recently coming up with many regulations over here.
It is. So the EU is coming up with a lot of regulations, and I've been also talking to institutional investors. Of course, regulation creates a level playing field. Regulation is the same for everyone. But at the same time, it's also killing innovation. So you have to be a little bit careful on how you create regulation. It should be created in a way that the markets can still breathe, and that the markets can still go for innovation concepts. Because a level playing field is just a cost. A level playing field will never create an additional return. So it will not create any alpha.
That's great. Now, knowing about the diverse aspects of sustainable finance, I know it may be a cliche question, but how would you differentiate between impact investments and ESG-based investments, sustainable investments? How do you make those differentiations?
Okay, that's a very good question. So I
Thank
think,
you.
yes, there are. I would say there are mainly. So yeah, it has been a very innovative space, and therefore there is a lot of terminology which is not always very consistent. But let's start with SRI, so socially responsible investment. So that's the first thing we had, and these were companies taking an index and weighting the assets in the index differently than the index weighted it. So they were overweighting what they thought is socially responsible or is good for society and environment, and they were underweighting other assets. When you recreate an index, then what you're normally doing is when you know the Markowitz formula, for portfolio management, where the market is really right and where the market is really creating the diversification that assures that you will have the best risk-adjusted return. Then, of course, when you're starting with overweighting and underweighting, what you're creating is a tracking error to the index. So the first question is, how big is the tracking error to the index? And very much in the beginning with SRI, the tracking error was very small. So you are having a small tracking error, and for the small tracking error, you expect to have a better return. So this is in a nutshell what socially responsible investment is. So then the market took that concept a little further, and we had the ESG concepts like filtering out negative assets out of the index, and creating best-in-class approaches or integrated ESG. And these indices, so there are some questions that you always should ask the portfolio manager. The first one is how large is your tracking error? Because you are getting a better performance because you are accepting a tracking error towards the index. So you are buying the better performance because according to Markowitz, you cannot beat the market. The market is always right. And when you create an index, when you create a portfolio that deviates from the index, which is the market, then you create a tracking error, and the tracking error should pay off with a better performance. Yeah, if this is not the case, then then maybe you should just take the market as it is. So with ESG concepts, we're filtering out negative, controversial industries. We are applying negative filters for it, and we are applying more sophisticated tools like getting better data, also more not only quantitative data but also data from soft sources like LinkedIn, Twitter, and so on. And we're trying to beat the market, which is having a better data quality and better information. Of course, in ESG, we also accept the tracking error, and the tracking error in ESG might be bigger. But you're still taking the portfolio as it is. You're taking the Dow Jones Sustainability Index, you're taking the Standard & Poor's, you're taking the MSCI. So you're taking very normal market indices, which are listed and which you really can look up every second. When we talk about SDG aligned investing or the EU Taxonomy, then we are changing that because we are creating our own investment universe. We are forgetting about the index. We are taking a positive selection methodology, and we're saying, well, this is our investment universe. This is what the EU did when they created their 2 climate benchmarks. So the green and dark green climate benchmark. This is exactly what they did. They said we only want climate-friendly companies in that index, and we are having a positive selection methodology, and everything else we're just out. So that's a very different approach, and it has we're keeping, let's say, the skeleton of the Markowitz methodology, as the investment universe still should have at least 30 titles, because the diversification effect only takes place if you have 30 or more titles. But we are not taking the entire market, and therefore we are taking a huge tracking error, and therefore we are taking diversification. So that's and in impact investing, we are even not so genuine. Impact investing does not happen on the secondary market. It's not companies, it's private placements, it's startups, it's seed finance, Series A, B, C, D. It is venture capital and private equity. So it's not, there's no market value. You have to do your own valuation of the assets. And so impact investing, genuine impact investing, really is happening on the private market. And there are different regulations here in Europe according to country. Some see impact investing just as genuine investing, so on the private markets, genuine impact investing. Some other jurisdictions take into account as well thematic investments. So they're of course investing to the secondary market according to a theme like clean water or biodiversity or whatever. So this is a very different, much more focused approach, and it's very new. So we don't have a long track record of it, and we will see how it works. Maybe one important last point. All these concepts we have been talking about, they are all working for active portfolio management. And 98% of all investments are into EFTs, ETFs are into ETFs that are just creating the market. So if there is an MSCI ESG index, then you can recreate it. If there's none, you are just investing into the market. There will be now a green climate benchmark index created by somebody in Europe. You can ETF on it. So as a passive investor, you can invest in that. But let's say in passive investment, the chances to do sustainability are very, very reduced because what you're doing mainly is recreating the indices that are available. And if there's an index on the market, then of course you can even product on it. You can, for instance, an exchange traded fund, an ETF. Um, but your possibilities to invest sustainably are definitely reduced.
That's very insightful and very informative to know about the different kinds of investments that's going on in the market and the emerging ones too. So I believe that there are many tools for any investor to make informed decisions already, and newer ones are coming up.
Yes.
Uh,
So, exactly. So the tools are getting more sophisticated over time, and they take in more information. So with big data, of course, you can load a lot of quantitative data. I'm also invested in firms that do machine learning. So you can set up a machine also on the S&P or on the MSCI and see through active rebalancing how can you do better than the index while taking exactly the same assets which are in the index just by having a better market timing. So this is this new trend of AI induced machine learning used in which can be used in asset management and wealth management, and that can help you really to get weak signals and not invest just in Bitcoin, but maybe let's say in a crypto benchmark of the biggest 15 crypto companies. And then hopefully you will, with this AI machine learning technology, when it runs for a certain time, so normally it has to run 3 to 6 months to give you a result, then you probably will not fall into a situation where you're buying Bitcoin at 60,000, but you are buying, let's say, the 15 biggest crypto assets, and you have through the machine weak information that something will happen, and you will reallocate and rebalance your portfolio prior to any of these hits taking place. So
is there a website where we can actually see these top 15 crypto assets, or
yeah,
is
so
it?
I can I don't know, I'm probably not allowed to make any how to say any marketing, but you can write to me and I can send you the
Yeah,
names of these companies. I'll put the company CEO then in CC, so he's aware that yeah
yeah.
that we have been talking about that.
Yeah. Sure, sure. That would be great. Also, it'll be of great benefit to all the viewers too.
Yes,
In fact,
absolutely. Absolutely. So that's also a very new technology, but we have at least live performances for a long enough time period to see that these methodologies are able to beat the market. And so that's a very new trend. And if that manifests further, we might see a situation in 5 or 10 years from now that a lot will be steered by AI in wealth management.
that's the world is small now.
Yeah.
Now, Karen, you have been the editor and you are the editor of Sustainable Finance. How do you see the future of ESG evolving? As there is a lot of talk presently about the subject.
Yes, I think ESG is still, well, as I said, it has its limitations as it is, based or footed on self-reported information. So the company is creating the sustainability report. There is no audit. So in principle, I could write anything in it. Um, And I think this is something which has created now a flashback for ESG. And I don't know whether you are aware of a paper that came out last year. It is from the University of Zurich together with MIT. And they have found a correlation between the ESG ratings of the two biggest ESG rating providers of 0.2. So that means there is a very low correlation, between their recommendations. So some see one asset as high in ESG, and the other rating provider might see it as very low in ESG. So a correlation of 1 means they are coming to the same result, and a correlation of 0.2 is there's a lot of disagreement in the market. And between the biggest rating providers. So MIT and University of Zurich, they called the paper aggregated confusion. And I think this is really, going to the point. The EU itself, so there is the European market regulators, so the ESMA, European Security Authority, and they have issued a paper last year saying ESG is not a consistent concept. And I think this is the biggest problem which we have with ESG. It's not a consistent concept because we don't have consistent information. So you can finally decide which provider you like more or with whom you make the best experiences, but they are not coming to the same result. So if you see, for instance, in comparison, the FRSI, so the financial ratings and the financial statements that have to follow regulation, there it would not matter whether you go to Moody's or Standard & Poor's or whomever, you would see a very high correlation between the ratings of these rating agencies. This is not the case in ESG. So that means that the concept, either the concept itself is flawed, or it has to be standardized. If it is standardized, because it will not create any innovation or alpha. And this is why the market now is very much moving to the next stage, like impact investing, like sustainability development goals aligned investing, to really look at the positive outcomes at the very early stage. So to say, okay, what is the business model of this company? How is the business model contributing to clean water, to education, so to the 17 UN development goals? And also there we don't have a methodology yet, but it could be, let's say, a more fruitful approach, as if you look, for instance, for ESG into the ratings into the Dow Jones Sustainability Report, Dow Jones Sustainability Index. Maybe that's a good example. So the Dow Jones has a sustainability index with the 100 most sustainable companies of the world. So this is all based, as I said, on self-reported sustainability reports, and based on that information, they create a list. There you have a lot of food companies, that produce lemonade with much too much sugar, and they sell that in plastic bottles. So they can be completely ESG compliant according to the Global Reporting Initiative criteria, but they are not, let's say, producing the right product for the market. So you still have an increase in adiposia, you still have an increase in plastics in the maritime areas. This is a problem which, so doing the right thing and doing the right thing for society is a different question than being blind. So you have companies like that in the Dow Jones Sustainability Index that still produce a lot of waste, that still produce a lot of plastic. That's our products, which might be not so good for your health, but they fulfill, let's say, rules. This is something that regulation is able to do, but it doesn't mean that you are creating a product for the market that helps fight because it doesn't mean that you are creating a product for the market that helps people understand how to eat and drink healthy and how to keep up your health. So that would be more, let's say, a company that is in the area of longevity and who has a business model of longevity. So when we talk about impact investing, the impact is in the business model itself. So it's something you cannot take out because then the company is dead. Whereas ESG is an add-on, and you could, in principle, so the food companies could take out their sustainability report. They would produce exactly the same lemonade. They would use exactly the same plastic bottles. They maybe would then use child labor or whatever. Or forced labor and have harmful impact. But it's something that can be taken out of the business model. Whereas in impact investing and SDG aligned investing, it's part of the business model. It's a business strategy. And you cannot take it out because then, you would kill a company.
That's very informative, and I completely reckon with you. You see, we use a lot of herbal and Ayurvedic products, which are again packaged in those plastic bottles so that it reaches us. So, and they don't even take it back.
Yeah. So, and you can still be in the Dow Sustainability Index with exactly that strategy. So it's not about really creating a good product which has a societal value. It's really about curbing the negatives, the biggest negatives that the Global Reporting Initiative has found. And have a norms-based screening, so to say, on your products. Yeah, that's a big difference. And I think we are now in the time where we have to find a transition to this new path, where we really have the impact in the business model itself, the positive environmental societal impact in the business model itself. And I think this is also a great chance for emerging markets because you can leapfrog. You don't have this old industries that are set up and they have done it like this all the time. But you can really, when you look into energy, you can create green energy projects. When you look into food supply, you can create food which is good for your health and which is not coming in plastic bottles. So you can jump over the phase that we had, let's say, in the more old economy, and you could use that leverage in the transition now to a more sustainable world.
It's such an opportunity for all of us, then, I'm sure. Mm-hmm. Now, Karen, we are an education and research institute. What are the knowledge gaps you have observed in the existing workforce and would like the upcoming workforce to be trained?
Okay, so we already spoke about financial literacy. I think this is a huge issue, especially for women, but I think overall, very often also for men. Or in the wider society. So we need more investors, and we need more investors that understand what they are doing and can ask the right questions. I think also that the behavioral economics aspect is really important. So you have to know your emotions, which can lead you into emotional traps in investments, like the fear to lose out. So it's extremely important that you understand behavioral economics models and that you understand concepts like sentiment analysis, because with sentiment analysis, for instance, you can see whether the sentiment, so the feeling towards a share, is maybe too positive or too negative. And whether you are coming early on in a trend or whether you're coming late in a trend. In behavioral economics, we are also researching topics like the creation of bubbles. We have seen quite some bubbles. The technology bubble in 2000, or the new market bubble in 2004, for instance. So you will better understand how bubbles build up and how they burst. And you maybe do not want to invest in a phase where you think there's overconfidence. Like in Bitcoin, there was overconfidence when it was at 60,000. So this should be a warning: don't invest, not at that time. Yeah. But normally the emotions are stronger. Everyone is investing, and you are fearful that you are losing out on on future profits, and then you are going into the market at a much too late stage. And so professional investors, they do have their professional tools. They don't do it, and very often before a market bubble bursts, there is a change of hands in the assets. So the professional investors, they are selling, and the retail investors, they are buying. So so as they say, money is moving from more professional hands to more uneducated hands. And you can see that as indicators. That's a very bad sign. So that's a moment where you should not invest. And so I think we need a lot of more education in behavioral economics and behavioral finance, and also with these event studies that we do in behavioral finance, to understand when to invest, because we are all taught by Markowitz that you should invest in the market and then wait 20 years. You should not worry whether you invested at a high price or a low price, because the market will, in the long term, it will always go up. So it will not matter when you invested in at a bad time. So timing is not an issue. And in behavioral economics, we can see this is not entirely true. Yes, of course, you can invest into Bitcoin at 60,000, and maybe in 10 years from now it will be at 100,000, and then it will still have been a good investment. But you have to go through all these slopes where you can't disinvest, because if you disinvest now, you're materializing a loss, a high loss. And this is which in behavioral economics we try to find strategies that can even out.
Okay, that's very informative. It has been wonderful to have you with us, Karen. It's been almost an hour, and I can still keep going on what is GHG and carbon accounting and investments and carbon market strategies. But I know that we have limited time, and maybe we could schedule another session or later in the year. And what is your message to all our viewers who are watching you now or who would watch you later?
Thank you. Yes. Yeah. So happy to come back to you. Thank you very much for inviting me. And we can even dig deeper if the audience is interested in that, and go into carbon accounting and and all that issues. So love to do that.
Thank you so much, Karen. Any message for all the viewers?
So I think my message is start investing with small amounts and create really a laundry list of questions you want to put forward to companies. If you're a passive investor, I think everyone starts with ETFs and stuff like that. Then watch out for indices that have also a sustainability or ESG version. So the MSCI, for instance, you can invest into the MSCI, or you can invest into the MSCI ESG, and you have a very transparent overview every second, which of the two does better. And so integrate that in your decision making, and then when you have grown your wealth to a certain amount, start investing into impact. That's my message. Always start with small amounts, but do it.
Thank you. Thank you so much. We have a message from our viewers. Thanks, Karen, for providing key information on sustainable financial scenario, as well as on crypto. So that's from Mr. Satish Chandra Varma on LinkedIn. Thank you so much for watching us. And thank you, Karen. I hope to see you again and discuss more on these aspects. And thank you so much for sharing all your knowledge with us.
Thank you. It was a pleasure. Thanks. Thanks a lot. Yeah, thanks. Have a great day.